Hello, everyone, and welcome to today's webinar, Taking the Guesswork Out of CRA Valuations in 2024. I'm Jonas Locke, Vice President of Business Advisory Services in Canada for Altus Group. Today, our team is very excited to bring our newest webinar in an ongoing series of national events where we examine some of the big issues in the CRE industry. And I'm thrilled to say that we have over 2,000 people registered for today's live webinar. So thank you for joining us, and we hope in the next 45 minutes or so, you'll put some great insight into the state of valuations in what continues to be a very interesting market. Today, I'm incredibly pleased to be joined by three esteemed colleagues from the commercial real estate industry. So let's give a warm welcome to our three amazing panelists. First, we have Eileen Forglow, CFO, Epic Investment Services. We have Andrell Wisdom, Manager, Private Investment Valuations at Aimco. And we have Joseph Crescio, Director and the Global Head of Real Estate Valuations at Manulife. I thank all of you for joining us today. For those listening, feel free to flip over to LinkedIn and have a look at the profiles of our panelists today and learn a little bit more about their roles and experience. I'm going to ask each of them to weave a bit about themselves and their firms into their responses if possible. So for the discussion today, we're going to look at three kind of main areas and three themes. So firstly, we're going to have a look back at some of the past quarters. We're going to talk about the views on where the valuation trends are heading in 2024. We're going to look at some of the operations and processes around valuation, and we're going to finish off with just some high-level industry trends. And by the way, there's going to be a few audience polls snuck in there along the way, so keep posted for that. And which leads me to a couple of quick housekeeping items. Firstly, if you have any questions for the panel, please submit them in the Q&A box. If time permits, we'll get to a few of those. And if we don't get to yours, we'll endeavor to have someone to reach out to you post-webinar to see if we can answer some of those questions. And then one last thing is that today's webinar is being recorded, and everyone who's registered for the webinar today will receive an email link to view the recording. Should you want to either reference it later or pass it along to a colleague that couldn't attend today's webinar. And you expect that maybe as early as tomorrow. So stay tuned for that. And so without further ado, let's get on to today's discussion. So each of our panelists is exposed to many valuations over the course of a year in multiple sectors and in multiple markets. I'd like to start with you, Eileen, and just in a market that's been impacted by real estate volatility and diminished transaction volumes and a lot of disruption over the past bit, how would you characterize the current state of valuations?
Thank you, Jonas. So interest rates volatility has made it challenging for investors and for appraisers to accurately predict future cash flows and discount rates. And coupled with that, the interest rate environment today, we're also seeing a larger divide between the seller's expectations and buyer expectations, which has resulted in a really diminished transaction volume market for 2023. All these factors all together, I do believe when we came into valuations for 2023, it became very uncertain and challenging for internal appraisers and external appraisers. So, we can't go through traditional valuation methodologies all the time. And so in these heightened times of volatility and uncertainty, investors and appraisers should really have a bit of more focus on the underlying key real estate fundamentals, such as location, property conditions, and how well the assets manage the asset class in addition to rental income potential.
Right. So Joe, in moving over to you, is this similar to what you're seeing over the past few quarters, or is there anything maybe that surprised you recently?
Yeah, that is consistent with what we're seeing. I would say in terms of the biggest surprise, when you look at the index and the indices, MSCI specifically is what we generally track against. You look at the kind of the quarter over quarter and the year over year change. As Eileen mentioned, there has been a lot of kind of pricing discovery. There's been a kind of lack of transactions. And typically when you go into this period of time in the cycle, everyone can agree that when there's a lack of transactions, that's probably not prior pricing probably doesn't hold quite as it did prior. And the question becomes, it's down. The question becomes how much. And it's surprising to me that the index didn't move quite as much down. And there was a lot of folks will quote a lack of transactions. Here at Manulife, we've been very transparent with appraisers. A lack of there's other transactional data points besides sales, right? You can talk to brokers, you can get BOVs if there's a property out in the market. That's a data point. Maybe we're not sellers of property at certain prices that we're receiving, but that's data points nonetheless to share with appraisers. So it's surprising to me that everyone's kind of hanging their hat a little bit too much on lack of transaction. For that reason, it seems the index hasn't quite reflected what I would say would be a more meaningful adjustment.
Right. And then over to you, Andral. From your perspective at Aimco, was there any particular sector that kind of dominated the discussion for your teams? I mean, we know that we've seen significant, retraction in values for office, but there are other sectors that stand out for you.
In every asset class, and thanks, Jonas, for having me. Every asset class really does have its time under the sun, and it goes through cycles where no one will touch with a 50-foot pole. So, of course, in our shop, the office story really took up the lion's share of the discussions. But I think all of the asset classes really had some various nuances that made them have some discussion. And I think with the question, I think the way it was kind of phrased around office. The nature of that question, I think, is a little bit slanted towards the negative headlines around office and that asset class. But for us, even within the segment, the variance in the management practices we've seen can really have a material impact on the performance. Whether you're being defensive and leading the market, say by spending capital over time to reinvest in the buildings, or if you're taking more of a measured approach. Conversely, if you're more so playing catch up. And having to spend all that capital now, you're in a much more difficult position. But, the reality is the largest single mover in our portfolio, and I think based on some of the performance data we've seen, seems to be the case across our peers as well, was the run up in the investment metrics and the yields, which I know for our portfolio managers and asset managers, I think in a lot of cases was quite frustrating, because even when you're completing, strong leasing and doing deals and such, you're still seeing values come in as flat, or in some cases moving backwards, because just the shift in the macro picture as a result of interest rates moving up and the risk premium for real estate. It's been a challenge. So, outside of office, I think our portfolio has, the story we've largely told our valuation committee, and what's been relayed to clients is ultimately, the industrial market has been performing super strong. But in 2023, our external appraisal partners, they really started to focus in on like the cash flow yields and the NY yields and such, and trying to reconcile that within the valuation, which ended up having a more, significant impact on the valuation downwards. So that was a challenge. On the retail front, we actually were quite impressed with the strong sales performance that we were seeing in a lot of our malls, which was excellent. And, we weathered the storm of Nordstrom packing up and leaving kind of out of nowhere, which was a challenge. We also had discussions around the Von Mills transaction, which was also a big item. Multi-res side of things, we also saw cap rates starting with a 4 still in multi-res in some of the key markets, it created some questions, but ultimately speaking to the supply demand fundamentals. So, all that's to say, I think, all the various asset classes gave our group a reason to hold a bit of a magnifying glass and understand and chat about a bit more.
Right. It was an interesting point you made there around, the specifics of the asset. I think, our profession, we were making some more broad sort of adjustments early on in the cycle. And I think as time progressed, we were forced to start to look more asset specific and market specific. So it's a really interesting point. And as I mentioned in the intro, we will be throwing in a few audience polls during this webinar. So our first one is should come up on the screen here shortly, and it relates to the frequency of valuations. And so the question we're asking here is, as a result of current market conditions, what do you think is the right frequency of valuations? So maybe as we're waiting for some responses to come in, just flip back to you, Andral, for another follow-up question.
Sure.
Do you feel 2024 will be more predictable in terms of valuations, or do you think things will settle down, or do you expect the same sort of volatility as we move forward?
Yeah, at least from a Canadian context, I think it's going to be a mixed bag ultimately, and it's going to offer some challenges and opportunities. So there will be winners and losers as always. I think the outcome is really going to depend on the composition of various portfolios that folks own. There's a clear difference between, as I was mentioning before, assets where the right investments have been made into them to future-proof them. But those assets that might be, lower on the scale in terms of quality and such, they're going to continue to experience challenges. But, to step back a bit, I think everyone's waiting, holding their breath to see what the story is going to be with interest rates and how that's going to shake out. And I'm not going to share my crystal ball because I've consistently been wrong with that. But the reality is that that factor alone is going to really have a knock-on effect on the direction of spreads and whether cap rates are going to ultimately move materially upwards for the asset classes. So, and that would be regardless of individual asset performance. So, I think in Canada specifically, speaking to Canada, I think one of the single biggest positive tailwinds by far is going to be the significant population growth we've seen, which of course has a direct correlation to the demand for all real estate classes, and Canada's set to lead the G7 in terms of that side of things. And so I'm also expecting to see liquidity and the cost of capital improving. But deal volumes, we saw that they were down for 2023, but we did see some of those good sized transactions go through, like the Von Mills one I mentioned before, or Allied doing that data center deal as well to sell some of that portfolio. So really, I think that's kind of the long-winded way of getting to the classic answer of it kind of depends. And I really do think it's going to be a question of the composition of the various portfolios by asset class and geography. That's going to be the key impact drivers with the volatility equation.
Right. See if we have any responses ready to show here. So it looks like not the overwhelming, but a fairly interesting mix here actually between quarterly, semi-annually, and annually. So not a lot of people suggesting monthly valuations at this time, but certainly there's a support for quarterly, semi-annually, and annually. So that's interesting. So maybe if working off of this, moving over to Eileen again, from your perspective as a CFO, see positive trends in the industry around things like frequency of valuations and transparency, and is like expanded data and analytics evolving throughout the year as we move forward?
Yeah, so that result was actually quite surprising because I was expecting to see way more quarterly because that's just my natural instincts. But yeah, I think overall software has helped us in gathering more data and more analytic data points. But what I do think is still lacking in the Canadian landscape, and I can only speak to that, is, I still don't feel there is a lot of transparency. I think there's not enough of information sharing, I think, overall. And I still find it really quite hard to find the information because I think overall, until I see more regulation surrounding more transparency to appraisal data or the requirement to doing appraisals externally more frequently, which I think a lot of people did say annually here in the polls. I don't see that significantly changing, and I think a lot of the real estate still held by privates and institutional investors, where I think those cards are still very close to our chest, right? And it's still a little a bit protected in my view.
No, it's interesting. Yeah, I as you was a little surprised after the poll response. I thought we would see more semi-annual and quarterly, to be honest with you. So it's
Yeah.
interesting. I just want to maybe move over to Joe again. Joe, I mean, as you prepare for 2024, and maybe you could talk a bit about the way your team's approaching it. And is there anything that you in particular are focusing on in the way of metrics? And maybe what's the bit that's changed for you as you kind of move into this year?
Yeah, sure. And actually, I might just add a little bit to that prior question as well. Just regarding the frequency, I'm with you both. It's surprising that we haven't seen the frequency increase. But I looked at it. I think it really depends on the fund, right? So we have certain open-ended funds that are traded in and out of on a daily basis. So those ones, monthly, it seems like a no-brainer. If I was an investor, I'd certainly want them to be reflecting any, changes in the market or at the property level real time. Whereas if you have maybe a closed-ended funds that, that there's one single investor, you have a little bit more flexibility there. And maybe you have a large portfolio and you kind of bifurcate into the larger assets and the smaller assets. And maybe the smaller assets you only value like annually and the others you do quarterly, depending on the client. So it's really, I think, client by client, the point raised earlier. In terms of things we're looking out for as we move ahead in 2024, we're just keeping a close eye on the cost of capital. The majority of market participants use debt to transact, and so not all. There's some cash buyers out there certainly, but the cash buyers are reflecting the average market participant behavior. Just because they're a cash buyer doesn't mean they're going to take a lower yield when the market is commanding a higher one at certain times. So specifically like for industrial wallets and where your contract rent is relative to market. We're keeping a very close eye on that, just because you're not going to be able to get that NOI pop oftentimes until that rent burns off. So if there's limited NOI step ups, those, if you take them out to the market today, oftentimes there's not quite the demand there was before when interest rates were lower. That being said, the Bank of Canada rate has come in a little bit. So I think that's kind of a key metric. Obviously we're looking at transactional and all the traditional data points here, but we're really, the last year has taught us, and it's really kind of keeping a close eye on the cost of capital, how that impacts values. It's not always going to be a one-to-one, but it is a helpful data point when there's not many data points to go off of.
Right. Maybe just, Eileen and Joey both kind of commented on the full question. Maybe Andrel, the same kind of stand out to you. Were you surprised at all at the responses?
Yeah, certainly. I mean, I think at least for our group, we do operate on a more quarterly basis, and granted, like our mid-year as well as our year-end cycles are a bit more heavier in terms of our evaluation process, but we do perform some form of review quarterly. And our understanding, at least from some of the stuff we've seen, similar to what Joe was mentioning, I would expect to have seen people looking for more frequency, particularly as we move into cycles that are a bit more volatile. People do want to get their assets benchmarked more on a more consistent basis. But again, I do think it probably will vary depending on the composition of this group who's on this call and what their fund structures are and such. But I would have expected to see more leaning towards frequent valuations. I've even heard some folks going daily, which is that's quite a bit, but I think that's kind of the direction things are hoping to go.
I wonder too if as technology evolves around valuation, if it maybe helps push us towards more frequent valuation. So I mean, maybe a quick question that wasn't discussed with the panel prior, but is there any thoughts around technology maybe promoting more frequency in valuations? Are any of you seeing that perhaps in your firms or here in the house where?
Well, I think I attended like a breakfast this morning, and the focus was on AI, right? And how do we kind of really leverage AI to help us do some of that data input? And really, when you break down how you do evaluation, there's some key data points, and you can teach it how it can spit out some numbers for you. And then that's how I feel. I think there is the ability to leverage off of AI to help us in doing some of the valuation work.
Yeah, that makes sense.
Sorry, Jonas, that's good jump in there. Just having a rock solid process is kind of the key, and kind of being proactive and having, like, in some of our contracts, we actually wrote in, if needed on a more frequent basis, here's the fees and here's everything. So you don't have to go back and re-engage the appraiser. If there's an optionality, we can say go, and that kind of, that in addition to just having good software, good process, et cetera, kind of, you need to be ready for it. It's hard to, be reactive when that time comes up. So just kind of being proactive and getting kind of everything in order, kind of anticipating the need that might come up, because macro shock, or maybe it's a big lease or something in a building that you can't wait for that next month or next quarter to reflect that.
Right. No, and that's a great segue to where I kind of wanted to go next. With the conversation is kind of into the valuation process. So I was going to maybe swing back to Eileen just for a question around, what do you consider to be your typical valuation process in Epic? Is there a standard process, and maybe a bit about how that's come to be?
Yeah. So, leveraging off kind of what Joe and Andrel has already mentioned, depending on our investor, and what their requirements are. We manage all four asset classes, for all the asset classes, and what we do typically like to do is get the third party property valuation opinions, and where possible, we do like to have different appraisers from different regions kind of doing the opinions, because what we do see is, back to my transparency, we're not seeing as much transparency. So working with different appraisers allow us to obtain different data points and different appraisers' perspectives to compare against. So, our typical process is really submitting all the data and getting feedback from the appraisers. But what we did realize, and what we have been focused on the last few years, is really a great focus on the global market assumptions, any of the leasing assumptions, the tenant inducement packages, and just really ensuring that there is right downtime in the Argus models. Um, we're managers at heart. We live, breathe the assets. We know how it performs and how it acts, and we want to make sure that all that is replicated in the model that we're getting, and ensuring that it's mirroring what we're seeing in the market. And once we get that data, we really want to review that and be able to explain the changes and the key drivers that are causing the valuation to change. And that could be, from cap rate, discount rates, and NOI changes.
Right. No, that makes a lot of sense. Andrella, I know you and your team at Aimco have looked at your valuation process fairly recently, in fact, and over the last few years, and maybe talk a bit about what you've had to change, and what your focus has maybe been in terms of your process. Yes.
For sure, yeah. Even at least right now, we're actually currently undertaking an internal review of our process and policy to just to understand, not just how we operate, but how are we kind of structured relative to our peers, to understand what we can learn in terms of best practices that are out there. For our European portfolio, right now, one of the key things we're looking at is actively working to integrate a DCF analysis into the process. Over in that part of the world, it is largely predicated on TradVal approaches for income producing properties. And in talking with some of our peers, we know that they kind of moved that direction already. And I think we will get there soon. And I think from a transparency perspective, and reporting, that's going to really help us and to create more uniformity in the valuations, which is really key. Coming to our Canadian portfolio, moving our multifamily assets to now include a DCF within the analysis, where previously we were kind of only seeing that within our US portfolio, but particularly in markets where we operate like Toronto and Vancouver, and seeing the dramatic run up in rents, it was getting more challenging to explain, extremely tight cap rates being applied within just a direct cap approach. So being able to explicitly reflect that in the modeling has been really helpful for us in explaining the inputs that have gone into the reporting and the analysis, and make things a little bit more smooth and efficient from a review process. In terms of the oversight of the valuations process, we run a pretty lean shop on the real estate valuation side with Aimco. So as a result, we've really tried to focus on trying to improve our internal collaboration tools, and we're not quite at the stage of using AI in a meaningful way to run parts of our process, but we are using tools like Microsoft Copilot, which just rolled out for us in a pilot project, that is. So, we're testing some features and trying to take advantage of some of those ChatGPT type functionalities to, speed up some of those processes. But I think probably the largest step for us in 2023 was we did onboard the entirety of our Canadian real estate portfolio onto the Altus Value Insight program, which quite honestly has been really great for us. And we trialed it for several quarters before making that leap, because we need to make sure that it would serve the purpose we're looking for. But really the main driver in recommending it internally was, we are trying to become much better at collaborating across departments and across all the various appraisal firms that we do work with. And it was increasingly becoming a pain to have documents sent to us in 100 different formats through like ShareFile or an email with a zip file or some other file sharing platform, and so on and so forth. And to simplify that and allow us to take, more of a 1,000-foot view of our appraisals that are coming in, and be able to really drill down into some of the metrics and such. That's been a really tremendous step for our team. And, I do have to give a special shout out to Rob Santilli, who's really been phenomenal as an extension of our team to help making the adoption of that program a lot really smooth, because especially when you have varying levels of user comfort with things, it can be quite challenging. So, for everyone on this webinar, I promise that this is not some kind of paid advertisement for the platform. This is legitimately, in our case, been extremely helpful because there's just so many people that do get involved in our process. So being able to have a tool that can really help manage and allow us to extract some data and benchmarking capabilities has been a really key improvement for us.
Right. Yeah, and yes, I think Rob will really appreciate you mentioning on the webinar. So thanks for that. One of the things that I did pick up on what you were just saying was your move to DCF for for multi-res assets, and I know that's something that's a big part of our focus. I'm curious if either of the other panelists, starting with Eileen, is that something that we're seeing as well, that more of a push to DCF for multi-res?
Yeah, I think with the lack of information, the volatility of the interest rate environment, we are pushing for DCF. We really want to see that discounted cash flow and what that yields to get to the valuation. So it's not dissimilar to what Andrell's pushing for.
Right. And Joe, I would imagine that's true of Manulife as well. And I guess would that extend into some alternative investments as well that you're starting to move towards DCF? Or?
Yeah. I mean, us as market participants, right? Appraiser or valuer is supposed to be putting themselves in the position of a market participant at the end of the day. No market participant is just throwing a direct cap on a multifamily. It's a great check. It's a great high level check, like it is on across all asset classes. But we're actually putting that into our contracts that we're requiring a DCF. It allows us to aggregate the data more effectively and compare it effectively across asset classes. I understand the argument as to why direct cap is sufficient because the perpetual, a lot of cases, perpetual below market leases that never get to market. But it's helpful to see what is market, what's contract, what does that spread look like? And then you compare that across your portfolio, making sure that your yields and everything's kind of priced appropriately. So yeah, we're definitely making that push. And then again, we can compare it across other property types and other geographies and sectors and compare it apples to apples. So it's great. And again, the direct cap still important. Don't get me wrong, but that it's more of a check on the DCF. So just think that that's overall the right thing to do.
Right. No, that makes a lot of sense. And Joe, just sticking with you for a minute, I know that one of the things that is really unique to your experience is that you're US based and you see a lot of valuations that are in the US and then in Canada. And I guess I'd be curious to know what maybe you're seeing in terms of the valuation process. It's unique to Canada, and maybe if there's Canada, how does the industry kind of compare, and is there any need to catch up, say, to other parts of the world or anything like that?
Yeah. So I oversee both Canada, the US, and our APAC investments. And where we can, we try to be as consistent as possible, like I described with using multifamily DCF. Specific to Canada and US differences, they're very similar. I will say that there's kind of global assumptions that are more common in the United States. For example, the treatment of free rent. A lot of times it's pretty widely accepted that is explicitly modeled in the DCF or in the model in the US, whereas that could be like layered in with TIs and stuff. In Canada, you look at like vacancy collection loss on single tenant buildings. There's kind of like some inconsistency there. Obviously, the difference between using DCF or not DCF. So I think they're just like more widely accepted quote global assumptions used in underwriting it in the US. And I think this will kind of come naturally as auditors raise questions, as clients raise questions. But those are kind of the few things. But by and large, it's largely similar. I mean, the biggest difference, when back to my original point of kind of the biggest surprise of the index movement, the US had kind of significant write-downs throughout 2023. It's just the US is a larger market, both in terms of number of institutional properties, as well as market participants. Whereas Canada, there's just not quite as much. And secondly, there's, leverage differences. So, in the US, there's generally more leverage, more IO loans. It's never a good look, but it's more accepted that there could be a default and toss the keys back per se in a down market. Whereas in Canada, that's not absolutely not quite as common or is accepted. It's not a good look on either geography. There's kind of these key differences, which is why I think you can kind of see why the US has gone out. There's just more transactional data points and more of those kind of default situations. Not that appraisers hang all their hats on that, but it is a data point that really can't completely be ignored. So I think those are kind of valuation nuances and specifics, but also kind of like at a macro why you're kind of seeing a difference between the two geographies.
Yeah, I think it's fair to say that the U.S. market has always acted in a more dynamic way and probably has been quicker to react typically to changes in the market as well than, say, Canada, for a lot of the reasons that you mentioned. Maybe just one last question around process, and maybe this one goes back to Eileen, and it's just you talked a bit about what your process looks like. I guess I'd be curious to know if there's parts of it that that you think you're going to be looking to improve moving forward, and maybe there's parts of the process that that you're that should be modernized or something along those lines. I'd be curious to know future looking with progress or with process rather.
Yeah, so kind of leveraging off of like Joe what was saying, in the States, the global market assumptions are a bit more, I would say, similar, and you can kind of leverage off of that. In Canada, it behaves a little differently. You do have to get into all the details of every deal is a little different. You have to review every deal. And so what we did find internally is that we have technology out there that can track changes, and you can kind of see what's changed over time in every um, iteration that you make changes on a document. We do find it a little hard, like, and we do have internal checks and balances and items to ensure that what changes were made to the model, but there isn't a quick audit trail to show like, oh, these were the assumptions that were changed, and this is what changed, and this is why these are the drivers of the change in the value from the first draft to the second draft. So what we noticed was, we could kind of start to use technology to help improve the tracking and the iterations as we go through evaluation. That would be helpful for us internally. And I think, highlighting what Andrel said earlier was using the AVI platform is the right step in the right direction to gain more transparency, more data, more information, and data helps us allow us to predict better, right? So as we feed this engine with more and platform with more information, it allows us to have a tracker of what's happened and allows us to actually sit back and evaluate, is this the right value? Are we proposing the right value? Have we considered all aspects? So those are things I'd like to see kind of coming into 2024 is a little bit more of iteration tracking and be able to track and explain those differences a little quicker and easier, and using the platform.
Great. I think that brings us to our next poll question of the day. So we'll get that flipped up on the screen here shortly. And so what we're looking at here is just what asset class do you expect to perform the best in 2024? So we've got the 4 selections for you. And that segues in nice to a conversation around valuation performance. And maybe just back to Andrel, and it's a question around, as a result of kind of where we are in the market today, how you did talk a little bit about your use of ABI, but I guess I want to just talk a little bit about performance management and what are you guys, what is your team doing differently today, or what are you looking to do maybe around performance management, and if you could talk a bit about that.
Sure. So, I mean, we're constantly looking for ways to get better and to improve. And, the evolving market conditions have prompted our organization to really lock in and ensure our valuation performance management practices are tight. And I think I'll limit my discussion to really just 2 main elements, which is collaboration and going back again to data. One of the key things that we've done internally is to really increase our emphasis on communication and collaboration among our team. Which is then shared externally, of course, to our clients and our various stakeholders. And, particularly in this complex market environment, sharing insights and updates and forecasts, it's really crucial to navigating some of the uncertainties. And, years before I joined the team, I think there was, a lot more silos involved, a bit more hoarding of information among departments. But really in the last few years, with some of the key changes in the organization, we've really been fostering a culture of transparency, and open dialogue across teams, which has really helped to ensure that our valuation strategies are as best aligned with market realities as possible. And ultimately, our group, we are active in the market. So having access to some of the best available data, which ultimately is a benefit to our clients so that we have the best information when we're making decisions on the valuation side. And then, of course, going back to the data side, improving the data analytics that we have and that we share with our evaluation committee has really been a point of emphasis. For our team in a quarterly cycle, we're taking a ton of information. And so one of the challenges for us can be, how do we relay that in a way that's not giving, a 100-page document and making it very succinct. So for us, recognizing the importance of accurate and timely data analysis, and also trying to integrate some of the analytical tools we talked about earlier has been really important. So, while we're layering in some new stuff, we're also trying to refine the existing processes to make them as effective as possible too. Which sometimes it just needs some tweaking and to really help to move the needle forward. So those are kind of the two key things we're looking at from a property management perspective.
Right. And let's just see if we can get the results popped back up. So maybe as no surprise, the majority of the attendees are looking to industrial to kind of lead performance in 2024, with retail falling shortly behind, and office obviously lagging. And in terms of other, we purposely left multi-res off there because I feel like that would have been the dominant answer. But other, at 27% is interesting as well. I guess quickly over to our panel. Any thoughts on that? Perhaps are you surprised to see industrial leading the way?
I'll comment first. I think there's a high benchmark that's been set. So, outperform, I'm not sure about that, but, I think there's lack of, the vacancy rates are still very low. So I think that's why everyone feels that way. The other is interesting because I don't know if the other meant multifamily, or it could be data centers or other asset classes out there that could be quite interesting, I would say.
But it is interesting to see people are looking away from the three main asset classes, for performance. So that is interesting to take from that.
Mhm.
Yeah, I think retail too might be a pleasant surprise this go around. Yields were already, elevated to kind of begin with. And so, I think all these sectors have to depend on where, the Bank of Canada rate is gonna end up. I think industrial is probably the most sensitive to that because of those, locked in cash flows. The majority of industrial assets have, wallets that's like 5+ years. So that's very susceptible to more susceptible to interest rate movement than other asset classes. But I think retail is interesting. Usually there's a grocer anchor, there's some certainty in those cash flows, but then you kind of have that upside potential. So I think that's one I would probably keep an eye out, in my personal opinion.
Right. Indrel, anything surprise you there? Those responses?
No, I think industrial has been the darling, so I can understand why that was kind of the predominant answer, and I can see that. So exactly what Joe said, I think you have to be kind of careful, considering that it is quite sensitive to some of those risks. But I think there's a positive story for potentially for a lot of the asset classes. Multifamily, we have some data center exposure to as one of the other groups, and those are still, we are believers in that as well. So I think there is good stories out there for some of the asset classes, but I understand why industrial was the darling for this poll.
Right. And I just want to stick on the topic of performance just for a couple of minutes here, and just we heard from Indrel around how you're looking at valuation performance management. Maybe over to you, Joe. Similar question. What pressure are you seeing, or maybe have you felt produce some different analytics or some more performance-based metrics, I guess, that you're using?
Yeah, so I talked about, kind of the year one implied rates we're looking at based on those contractual. I mean, taking a step back, our portfolio management team, our oversight teams, everyone's looking for more data on valuations. One thing to tell the story, but you have to have the data to back that up, and it makes it more compelling. There's just more of an emphasis on accuracy and timeliness of that data. So kind of having a good, system in place that's able to extract all that in a consistent format, i.e. them all coming from the same DCF, so you can have terminal cap rates and discount rates on everything, not just implied. That's that's helpful. I think as investors look to deploy money, particularly in our open-ended funds, they want to see what those metrics look like, and to be able to produce those in a timely, consistent format is critical in this day and age.
Right. And Eileen, I know you mentioned a bit of this already in one of your previous responses, but in I think when you talked about some of the key data points that you look at, I think you mentioned IRRs and you mentioned yields and you mentioned some market rents. We just walk us through kind of some of, what are the main, half a dozen or so metrics that you're really focusing on right now for valuation performance?
So for sure, we want to look at the changes in the NOI. We want to look at the changes kind of in the cap discount rates and the cap rates, and in the absence of market data, because there's no trend, there's diminished transactions. We are going back to data points, and just like Andrella and Joseph had said, is it's calling brokers and asking them, okay, well, what data points are you guys seeing and ensuring that the valuation models are showing up the same way and the appraisers are showing this data. Um, Cash on cash is huge, like just ensuring that there is a cash on cash return and kind of our model is also what we focus on.
Right. So that makes a lot of sense. And we're kind of nearing to the point where we're getting to our final set of questions here. So I thought we'd maybe flip it over to some high level questions just around industry trends. So maybe we'll start with Andral on this one, and being that you're part of one of Canada's larger pension funds, I'm sure ESG has become an important element of your business and your valuations. So I guess the question for you is this: has your team started at all, firstly, to incorporate any sort of ESG data in your valuations, and how do you think this will play out in the future? Do you see it being something that's going to be a bigger part of what you're doing?
Yeah. From an AIMCO perspective, we certainly take the long view to the assets in the portfolio, and our organization is really viewed ESG as representing a strategic approach to enhancing the risk-adjusted returns without necessarily sacrificing financial performance. And from a real estate perspective, we've really embraced ESG. And for example, in the last 2 years, I know our deal teams have implemented, screening for physical climate risk hazards as part of the pre-investment due diligence that's being done. We also report to GRESB, and for those who aren't as familiar with that, it basically they collect benchmark ESG performance across real estate assets. And AIMCO's portfolio has been shown to outperform its peers in a number of areas. But specifically from a valuations perspective, one of the great things about being in this seat, at least, is being able to see the range of approaches that to measuring ESG across borders. And there is no doubt that in Canada and North America in general, I think that we are behind UK and Europe. Over there, what we are seeing is the regulatory environments evolving rapidly, and at the forefront of the integration of ESG metrics into the analysis. The appraisers out there, they've been tracking and creating comprehensive data sets to capture the ESG attributes of the different assets, really allowing us to quantify some of the effects of the energy efficiency and the carbon footprint and government practices and so on. Last year I actually had an opportunity to go out and tour one of our shopping centers in Belgium, and what was indicated to me was that from one of the asset managers that ESG, it's not just, of course, it's important from an asset management perspective, but consumers are also voting with their dollars in terms of where they're going in that market, at least, and increasingly choosing to go to establishments that ultimately do show a commitment to those ESG principles. I think the most explicit example I've probably seen so far has come out of our German portfolio. We have a portfolio of residential assets out there, and we've actually seen appraisers applying an increased risk premium to the cap rates for assets that have what they refer to as an EPC rating that's below, I think, a C, and they'll apply like a 5 basis points increment for everything that falls, even to a D, to an E, to an F, and so on. Being able to take really a proactive stance on ESG considerations, it's anticipatory of what's the regulatory trends are coming, but I think it also aligns with the broader market shift towards just valuing sustainability. So I think from a Canadian context, we have a ways to go to catch up to that, but I think we can learn from some of our peers that across the pond in that sense.
Yeah, definitely important to see what's happening elsewhere in the world, and because eventually I have to think that it'll be an important factor in Canada, and maybe led by regulatory changes, but perhaps led by the market, depending on where we land. So, I mean, running here with our last few minutes, just maybe one more quick question for each of Eileen and Joe. For Eileen, maybe an opportunity to highlight some of the things that you're working on at Epic today. So just anything internally that you kind of would want to mention or highlight that your team is kind of involved in today?
Yeah, so we say unstable interest rates and lack of transactions. Maybe the capital source, where is it coming from? There isn't one. And I think what there is an opportunity in all that negative narrative, I would say today. And the opportunity is to, and I can see it, I see it, and ourselves are doing it, is really try to focus on a real true thesis and working through kind of lining up that capital. Once the opportunity is there, you can try and capitalize on that opportunity, right? You know, I think opportunities where not everywhere everyone is running to. It's where no one's thinking about it just yet, and that is, people are not focused on raising that equity capital. I know everyone's at the debt piece or bond rates right now, but I think there is that space for it for the opportunity. That's where we can actually realize some really great gains. So what we looked at in looking at, the ESG piece, we all know that coming out of, the last few years, entities that applied ESG actually were able to prove that they were sustainable and able to like kind of live through any of the challenges, right? And the E piece, we have targets and aspects that we need to meet already by a certain period of time. The S and the G aspects, we want to apply that in every day we do. And that helps us kind of develop a sustainable organization. And so one of the big things we do is a One Planet Living Fund that we are active in our first fund, and we've raised enough money to kind of we've invested in 12 projects, and that, helps contribute to bringing more homes to Canada. And that's 2,000 homes to the market in the next, I would say, 5 years. We know our mandate's 3.5 homes, over Canada in the next about 10 years. So we're hoping to contribute to that. So as we start to, use ESG and looking at deployment of capital, we are looking to hopefully raise our next OPL fund for Fund 2 in the coming months.
Yeah, much needed housing. Sure. That's a great initiative. And I guess, Joe, we get to finish up with you. You get the final say of the day. And I guess my question to you is just, with your appraiser hat on and what you're seeing from your position there in Manulife, what are some of the trends that you're paying most attention to, moving forward? Based question, you can go anywhere with it, but I'm just curious to see what you're really paying most attention to.
Yeah, I mean, from our process here, we're hyper focused on collaboration and just getting as much data as we can. There's so many different groups that my team interacts with. We have asset managers involved with our process, portfolio managers, transactions team. They sit on all our calls. We sit on all their weekly calls just to get real time data and insights to make sure that we're striking a credible nav in this period of uncertainty. And as soon as the market turns, we get other indication. That's how you discover that, right? We don't have to wait for a transaction to know where the market is when you can accumulate all these data points real time. So it's just hyper collaboration, and the only way to do that in an efficient manner is through technology. So we're just always looking to continually improve our process. I'll give a little plug here for all of this, but we implemented the AVI system about a year ago. And so it's really kind of fine tuning that and tweaking that and seeing how all of our various different service or internal clients or internal other partners are kind of use and get the most of it. And so we're able to aggregate all this great data that we have efficiently into one, make use out of it, and make the best investment decisions we can and make sure we're striking the correct nav and values in this period of uncertainty.
Yeah, no, there's no question that data is going to play an important part of all of our roles moving forward, and how we're collecting and analyzing it is going to be key for sure. So we are maxing out on our time now. So I just wanted to point out, if you have any questions, for the panelists, feel free to reach out to them directly. For any of you that have entered questions into the Q&A box, we'll do our best to get to those and get back to you if we can. And I'd like to firstly thank our panelists for taking the time out of their busy schedule today to join us. Rarely do we get the opportunity to discuss some of the internal practices and opinions of people that are this involved in the valuation game. So Thank you very much for that. I really appreciate it. And I know our listeners do as well. So please stay tuned into future podcasts and webcasts. And if you haven't already, if you would go to the Altus website and subscribe to our newsletter, you get the most current and up-to-date information on, what we plan to come out with in terms of insights and articles and things like that. And just as a reminder as well, a copy of today's recording will be sent out to you via email. So stay tuned for that. We hope to get that out to you really quickly. So once again, a huge shout out to our panelists today for volunteering their time. I thought it was some fantastic stuff in there, and I know I'm going to be going back and listening to it and picking up on a few things. So again, truly thankful for the time today. I really appreciate that. And of course, a shout out to all my colleagues at Altus for their help, in particular, the marketing team for organizing today's webinar. And for those of you out there, have a great day. Thank you for attending.